Does your financial advisor put his own money where his advice is? I'm Jack Otter, editor of BARRON'S.com. I'm here with David Lees, who is a senior partner at myCIO's Wealth Management. And David, one of the key components to your approach to building a partnership is the idea that you guys, you advisors, put your own money the same place that you invest your clients' money. Can you explain why that's important?
Yeah, that's one of our founding guidelines of our firm, is the alignment of interest with our clients. Just as an example, our 401k plan that we offer to our employees, their retirement plan, has the same list of mutual funds that we recommend to our clients. And we just think it leads to better due diligence overall, which is certainly in the best interest of the client. I think on the alternative side, which is a very important asset class for us, we're typically the first investor in our firm and our partner base, and we're always the last investor out. So we just think that leads to better due diligence on the investments.
So can you give us a sense of what you like on the alternative side right now, like enough to put your own money in? There is kind of a rap against hedge funds that you pay 2% up front, you pay 20% of profits, that it's awfully tough to beat the market that way. What's your argument?
And we share a lot of those concerns on hedge funds. I think the one area, the hedge fund asset class, and there's probably 40 different strategies within the hedge fund asset class, the one area that we focus on is long-short equity, basically hedged equity, which is a very transparent strategy, fairly liquid in terms of the ability to get in and out of the fund. We do think that there's a lot of opportunities, specifically on the short side, mainly because of the low interest rate policies over the last 5 years or so has driven down cost of capital. So there's a lot of what we consider as poor business models, companies that haven't allocated well, that quite frankly their stocks are higher than they should be. So we do think that there's opportunity going forward on the short side.
When money's free, you tend to spend it a little too freely. One key question is, for clients, of course, okay, the market was up 30% last year. You didn't want to be short. Your argument is when the market goes down, and it will, you're going to be a lot better off with that kind of allocation.
Yeah, our research has said that long-short equity captures around 75, 80% of the market up and captures only about 30 to 35% of the market down. So over the last 5 years, the best strategy would be to take as much beta risk as you possibly can at the lowest possible expense. And we think that just begs more for the opportunity on the short side from this point forward.
So how did you do in 2013, and maybe compare that to 2008 in case we have another one of those coming?
Well, composites in 2013 on the short side, or I'm sorry, on the long short side, we're around 16% on average. So certainly underperforming the market, but on an absolute basis, long short or the hedge asset class, earning 16% is a reasonable return. Back in 2008, our composites were closer to around 8% down, which again, just pure math, if you're 8% down, you only need about 9% or so to get back to break even, unlike the S&P that year, which was down 37.
So anybody who was down 8% in 2008 felt pretty good at the end of the year.
Felt very good at the end of the year on a relative basis. They're probably not at that point in time, but certainly at the end of 2009, they recouped all their losses that they had in 2008.
Thanks very much, David.
Thank you.